Now, I want to come back to shift to for accounting and finance. The same model, let's focus on accounting and finance a little closer. And before I go any further, I'll just say a few stories about Toyota and some of the shortcuts we were able to take. I already described the physical inventory, but as we learned the operation environment and the production system itself, one interesting story was we all know about material usage variances, right? So we have paint, we have steel, material usage variance. So at the end of the month, let's calculate what we should have used, what we did use. We have a variance. Let's ask the operations people to explain where it went. Very good. So as we were talking to some of the Japanese early on about the ideas of what we needed to develop, standard accounting approach, one of the senior Japanese said, I know what you're saying, but follow me. Follow me to the paint mix room where we hook up 300-gallon totes of paint, one after another. And he showed me the chart on the wall. He said, every time we open a tote, we will chart that tote. And if we see abnormal usage of paint, we know it right away, right here at the point of consumption. And we know why. And when we'll problem solve to make sure it doesn't happen again. We do that every hour, every day. If you bring a report to me a month later, even if I try my hardest to help answer it, I have no idea what happened 3 weeks ago, 4 weeks ago. So we scrap material usage variance. One does not exist. There's control at the point of use in the production system by the people religiously with their own data, their own charts, their own problem solving. It's a luxury from an accounting point of view. Big luxury. Second, labor and overhead and inventory. There's standard cost systems that put labor and overhead by rate, and they add it to inventory value, and it flushes through by part number, and it's very complicated. So what do? At the end of every month, we spend about 1 hour max creating a journal entry to assign labor and overhead to inventory. We just look how much did we spend on labor and overhead this month? How many cars did we build this month? There's the cost per vehicle. How many vehicle equivalent units are in process? Let's just assign labor and overhead on a reversing journal entry. It's done. That's it. There is no cumbersome system that's being flushed through and managed with overhead rates and labor rates and variances and all that stuff. So, lean accounting approach. Number one, deeply grasp your enterprise capabilities and practices. That's always number one. Second, identify your value added to the enterprise goals. And that's within the current capabilities and practices. Your value added differs greatly based on the capabilities of the enterprise you're working in. You have to understand that. So in the case of Toyota, we had a very strong Toyota production system, which allowed us to take the minimum approach to what accounting needed to do to support the operation. And when are costs committed? Most costs are committed, I think we know, when designing the product or the service and the processes to deliver the product or service. So when we understand that, material, labor, depreciation, for example, they're mostly fixed before manufacturing or before we deliver the service. Because the process we put in place is calling for the labor required to perform that process. Material is defined by engineering and design. What material grade are we specifying? What's the shape of it? All those things determine the material. And depreciation, obviously, the building, the equipment we put in place, it's all fixed up front. Before we ever build a car, we've spent a lot of money. Now we build cars and sell them and try to recover that money and have a profit at the end of it. So the standard product and process design processes are critical to cost management. So the operation, even though they're working in a box preloaded with cost, it is critical that their processes be excellent and continuous improvement because they're really the one facing the customer. If you're in service and you have a repair person out in the field, they're the ones facing the customer. It doesn't matter what kind of planning you've done financially or what you've said you do. That person is servicing the customer, and at the end of the day, that will determine whether that customer comes back or not. Open for questions if you have a microphone. We have about 5 minutes left, I think. Do we have cost accountants, and what do? We do have some cost accountants, a small group. What do? We have to understand our costs. We just don't build our system with all this bureaucracy and all this data in detail. But we don't need standard costing system and loading all these rates and running it through inventory. So there's a lot of understanding of cost needed. But it's done on a special application basis. And also understanding the trends of the actual costs and sharing those with management is a very important responsibility. And then what I didn't say, things like if I'm controllable costs out in operations, I need help. I need to understand what I'm spending on supplies. So if I get a daily report like a checkbook that shows me what I spent, where my money's going, I can do a good job of managing my activity on tool usage or whatever, or supplies usage. So it's a supportive approach. So there's a lot of things like that that's a value-added work of cost accountant. None of it is a bureaucracy of a bunch of data that nobody cares about and has no meaning to the organization. Very targeted, very focused, very value-added. Thanks.